Hello and welcome to REFM's Single Transaction Equity JV Partnership and Waterfall Modeling Level 3 Bootcamp. This is Bruce Kirsch, founder and CEO of Real Estate Financial Modeling. If you have not done so already, please go ahead and locate the PDF of the slides and the Excel file. Have those available on your desktop. And we'll start in the slides. Let's take a look at our agenda for this course. First, we'll discuss the rationale behind targeting what we call the disproportionate financial reward to the sponsor of a transaction and how to achieve that. In so doing, we'll discuss preferred returns. We'll give an overview of investment cash flow waterfalls, discuss IRR-based hurdles, and go through models for both single promote and double promote waterfall structures. When we introduce a second equity entity to now have a joint venture, it gets a little bit more complicated. So in this case, we have two equity investors or two equity entities. The entities can each have multiple members naturally. Let's think of an investor as one investing group. So we have the sponsor and the third-party investor. They're going to put capital into a transaction. That transaction is going to operate, and again, if there's a mortgage, it'll incur debt service obligations. And then when you have positive levered cash flow to equity, it's going to come out, but the splitting of the dollars that come out is more involved now. The first step typically, and we'll go through this in detail, is the distribution of a preferred return as well as the return of capital. And thereafter, there will be a residual profit cash flow splitting, and the proportions of those are going to be negotiated matters. Similarly, the level of the preferred return is also going to be negotiated, as well as the number of tiers or steps in that residual profit splitting structure. And we'll go through all of this in detail. Here on slide 11, we're just giving a very simplistic visual of a three-tier waterfall. A tier is a level of the waterfall as water or dollars flow from top left to bottom right. Tier 1 would be that tier in which the capital is returned and any preferred return is distributed. Tier 2 would be the residual cash flow split 1, or the initial residual cash flow split, and then Tier 3 would be the final residual cash flow split. So anything that is not distributed in Tier 1 or Tier 2 would be captured in Tier 3 and split, and there would be nothing thereafter to distribute. In terms of dollars out, we need to investigate this question here. Is a proportional or pro rata financial reward a desirable structure? So if sponsor is putting in 10% of the cash equity and the investor the balance, the question is, how should the financial reward pie look when the dust settles? Is this a desirable potential outcome? And so if you put yourself in the investor's shoes, the investor's putting the majority of the equity capital at risk, large majority in this case, and it would not be unreasonable for them to say, well, if we're putting 90% of the cash equity at risk, we want to walk away with 90% of the profit. Naturally, that would leave just 10% of the profit to the sponsor. So the sponsor would go in 10% and come out 10%. But that structure raises an important issue and poses a problem, which is one of incentives. The issue is that no matter how hard the sponsor works, no matter how well they guide the transaction to achieving its highest potential, they're only going to walk away with their pro rata share. Now, it's not unfair. They're not losing percentage points, but they're also not gaining percentage points. And so it would be much more desirable if the sponsor, given they produce terrific results above some negotiated threshold, could walk away with, let's say, 20%, despite having only invested 10% of the cash equity. And so that would then bring the investor on a net basis down to 80%. And so this, if I'm a sponsor, is a much more attractive prospect. And certainly if I have a choice of working with two different partners and assuming all else is equal, one partner offers me effectively a management incentive structure and the other one does not, I'm definitely going to go with the one that can allow me to walk away with an outsized profit. If instead the first dollars were to be classified as the distribution of the pref, what you see is the $1 million amount stays constant and the 8% is multiplying by that constant amount, and the total ends up being greater than the total if the dollars that came out first were to be classified as return of capital. Before we go any further, let's review the distribution description. So here it is. First, the preferred return will be distributed pari passu to investor and sponsor, so 90-10 in, 90-10 out. Second, investor and sponsor capital are returned, and then third, residual profits are split. Since we're just looking at payment type A on this sheet, we're just going to concern ourselves with the top portion here and make sure that we have a good grasp of that. And as we said, we'll then layer on the other payment types as we move forward in the lesson. It's important to understand that when we talk about a preferred return and we give it a rate, this is a targeted value. This is an agreement between the equity players that their money will earn at this rate. It's not a guarantee from the sponsor to the third-party investor. There can be guaranteed returns in some other context, but what we're talking about with respect to waterfalls is always targeted levels of return. So the first task that we need to do is simply calculate what earnings would be if the $1 million in each period were to grow at 8%. And so when we say the calculated preferred return or the accrual, once again, this is what are you earning at 8% on your beginning of period balance. And keeping the big picture in mind is very important. So for that reason, we always carry our total columns here on the left as opposed to out on the right, because on the left they're in our field of view. And so let's just review what we've done to this point and make sure we're comfortable with it. $1 million was invested. It earned at 8% over 5 years. That gets us to $400,000 in earnings. This is times 5. And then we have distributions of exactly 400,000 split 10/90. So everything here looks fine. And when we work in the other models in the exercises, it's going to be helpful for us to scan our eye down this total column to make sure that everything is looking like it's in order. The last item here is to solve for what dollars remain in each period, if any, that are available for distribution types B and C, which are return of capital and residual profit split. So 1.42 million, from that, $1 million is our return of capital. And then we'll have a residual profit amount available to split of $420,000. The investment, let's show that as negative Gross distributions will be shown as positive. That's going to be rows 22 and 23, and we'll put negative sign in front of both of those so that they sum to a positive amount. And net cash flow will be the sum. And so as we move forward, we'll see how do we go about doing that, and then how do we modulate different variables such that the sponsor's piece of the pie doesn't perhaps get too large if we're looking at things from the investor's perspective, or if we're looking at things from the sponsor's perspective, to make sure that it becomes sufficiently large. Let's flip next to tab 6 to take a look at how this analysis would look if it were to be modeled out monthly instead of annually. That is then going to feed our accruals for both the investor capital account and the sponsor capital account, and the formula is simply going to be the prior period ending capital and interest account balances times that monthly equivalent rate. So what we have here is the monthly is fanning out to the right here, and I've brought in the annuals. So let's just take a look here at the comparison. It's the same levered cash flow on a net basis as we said, and when you take a look at the accrual for monthly, it's $347,000, whereas for annual it's $363,000. And so the accrual for monthly is less than the accrual for annual, and that's for the investor. When you look at the sponsor, once again, it's less for monthly than it is for annual. Why is that? The question is, why is that? And if we take a look at the investor capital year-end balance, it's a very fine distinction, but if you look at years 3 and 4 here, where the blue line is the measurement on a monthly basis, you see that the capital year-end balance is actually less than that when it's measured annually. And you can see it with a little bit more detail here when you say, okay, this is the monthly modeled investor capital account balance. You see it starts to come down here as early as month 33. And so what's happening there is you are having capital that's being returned as early as month 33, which is in year 3. Tier 2 would be profits above what is paid out in Tier 1, and now you see there's a shift in the share of the cash flow that the sponsor receives at Tier 2. And naturally there's only 100% of cash flow that is available for distribution at each tier. So if the sponsor goes up by 20%, the investor on a corresponding basis. The best way to think about a tier is as a range of investment performance. And it's typically measured by the IRR, but in some cases it's measured by the equity multiple. Let's use IRR as an example here. So the range of performance for Tier 1 in this case, if the preferred return hurdle is 8%, and that would be an 8% IRR. And once we close the next unit, our net equity cash flow on a cumulative basis becomes less negative, and eventually hits break even. And assuming that we still have units to close, it's going to now become positive. And so this final bar is our total profit dollar number. And what I want to impress upon you is that that total profit amount compounded. So we solve for the amount that gets us to the $8 and then add to that the additional amount of $8 grown at 8%. And that gets us to $16.64. And so that would give us an 8% IRR over a 2-year horizon. Incidentally, it's always good to just play around with the inputs in these models to build your familiarity and your confidence and your understanding of them. So if we were to change the tier 1 hurdle to 0, what do we expect to see? Well, we expect to see simply a return of capital of 13.5 million, and we should see this full profit amount, right, which is net, meaning capital has already been returned, of 15.258 as what is remaining to distribute downstream. And that's exactly what we see. Once we make this hurdle anything greater than 0, naturally this number is going to come down. So let's go ahead now and step into tier 2. The beginning of period balance is simply going to be, could increase to 20 here. And so this went from 21 to 24. Similarly, this promote could come up even higher. That could become 60. So there's really two sets of inputs that can be manipulated to change how this financial reward pie shakes out, and it's really a result of monthly accruals and then the capital account balance. The red line is no refi, which is what we just went through, and the blue line is with refi. The blue line is actually sitting underneath the red line here because the refi doesn't happen until this month, month 36. And so what happens in that month 36 with that $3 million is it pays down our capital account balance from roughly 14 million to roughly 11 million. And as a result, the accruals are going to drop significantly. We're earning less because the balance is paid down some $3 million. The other curiosity you may have is, well, what if there is such a large refi that it repays all of the equity in the point of refi? So if I split my screen here and scroll across to that month 36, and I'll just hard key in a massive refi cash flow. So just looking at the investor, right, they still are owed roughly $13.4 million. So this cash flow would need to be quite large. So let's just make it, for the sake of illustration, 18 million. Well, if that's the case, then in that month, month 36, that 8% IRR will have been achieved, and we're on to tier 2 distributions from month 36 forward. Now let's flip back to the slides and talk about a double promote scenario. Everything that we've talked about to this point considers situations where there are 2 equity players. There are some situations where you have 3 equity entities, and what we need to do when we have those situations is to make sure that we have the right naming conventions in place so that we don't get confused as to which entity is which. So the sponsor that we've been referring to this point, as you know, is the owner of the asset or the developer of the asset, and the third-party investor or simply investor is a capital source for that transaction. When we get to a place where we have 3 equity players, we need to bifurcate this sponsor block into 2 discrete sub-entities. And the way that we choose to rename these entities is by... And so what you end up with here is what is known as a double promote structure, wherein the local sponsor receives a promote in a JV Waterfall agreement from the partner, and then that local sponsor, as part of the top-level sponsor, also receives a promote from the third-party investor. So this local sponsor who invests, let's say, 200,000 of those tiers flow into your waterfall tab from your cash flow tab. And then we show the equity cash flow as a sponsor, dollars going in and the investor dollars going in. Pari passu, 90-10, $20 million in total over 9 months. And the thought is that this is a development transaction, so we don't have the concept of time zero. Rather, we start the timeline in month 1. The Tier 1 and Tier 2 accrual distributions are right here, so we're just going to reference them in the 2 rows above, H43 and H44 respectively, and get those laid in. And then the Tier 3 accrual distribution is the first row where we have to do any legitimate thinking about how this is supposed to work. Plus 7 is 57%, right? And so maybe the investor thinks that that's too rich of a payout to the sponsor. Or maybe the sponsor sees that and says, terrific, that's where I want to be. And there's no right or wrong. Again, it's a matter of what's negotiated and how the deal plays out. The next thing that we're going to do is we're going to bring over the top-level sponsor investment amount from Waterfall number 1.